Hello traders, Gary Wagner with the gold forecast here on yet another historical day, October the 13th. It is Wednesday and this is the Daily Report. I know I'm sounding like the boy that cried wolf here, but gold has hit a new record high. As of today in the COMEX, it peaked around 1374.80 an ounce. Yes, 1374.80. And spot gold, Forex gold, is currently at 1370, call it 7070, 1371. You know, we have been looking for this run up to $1,400. That's the projection that I have been looking for. I'm surprised that we are seeing it this quick, but at the same time, I'm not surprised at all. For those of you who have been with me for over 3 months, say 3, 4, 5 months, you know that one of my largest inspirations for fundamentally looking at gold from the long side and believing we would go into the Super Bowl cycle was that I believe that gold is the new currency of choice, not an additional currency, but the new currency of choice. For those of you who have been with me for a while, you know this is not a new topic. You know that I have talked about the fact that when you looked at the debt crisis over in Europe, if you have a choice of having either gold or euros, which are you more comfortable with? Which do you think is going to hold its value? Well, now that we have this quantitative easing, we have really a currency war unlike anything I've ever seen because it's a race to the bottom. Every major currency, it seems, is trying to devalue their particular currency in efforts to jumpstart or boost particular economies. What is happening is gold itself has become the currency of choice. It's really that one tangible, hard thing that you can depend on. Now, interesting, when you take the $20 that gold is up today, $17 of that and change is due to predominant buying, while only $3.50 is due to a weakening U.S. dollar. The dollar is weakening, there is no doubt. But the perception out there right now, is that safe haven buying, and I think we are seeing the mass of investors, the bulk of investors, hearing about gold, entering gold, and so you have this tremendous upsurge in the market. If we take a look at what we're looking at in terms of this $20 move here today, let me blow it up for us here, traders. You can see we have not only exceeded it, but if you recall on yesterday's video, what I talked about is what's going to be really critical is to see a close above this 1365. I said that the next essential step that we really need to see before we are looking at a market that is going to continue on this upward path, we need to see on a closing basis the market moving above 1365. Well, we got that, and we got that 24 hours later. We are coming on a little bit early today. There's just so much to report all here on the Daily Report. I'm going to take a look at the daily charts. We're also going to look at the weeklies and a couple of technical indicators. Although I think that this market, although being technically driven, is really destined at this point. And I've used that word before, but I really think it's destined at this point to first hit the 1400 mark, and then for those of you who follow me closely, you know that I'm looking for about 1450, and this could come as early as the end of the year. Traders, we are looking at a weekly chart of the December contract of COMEX gold. I want you to see how strong in terms of tact or angle this last move has been from the 1150 area. It was at about a 45-degree angle just in terms of its angle, but is almost taken off in a linear fashion, exponentially moving up. We have had, in terms of straight weeks with higher closes compared Monday open to Friday's close. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out of the last 14 weeks. The only one we didn't see that, of course, was this bottom, and this is where we get that hammer down here. And this small doji that we had, this one consolidating candle. Now, the doji is typically a candle. Of course, it's one where the open and close are identical or very, very close. It signifies a consolidation in the market and a shift in power. However, all of that has changed. I am not reading typical candlestick patterns in the way that we have in the past, for the simple reason that what would typically be a indicator that we were looking at an impending bearish reversal signal, such as a hangman, such as a dark cloud, such as engulfing bearish. First of all, on the 2-day patterns, you need to get confirmation. We haven't gotten those on the dailies. And what we have seen is on the dailies where we had these small-bodied candles, rather than them being a shift of power or momentum, they were simply a resting point in which kind of fuel was being added to the fire before that market would take off significantly. You're getting this continuation, this 3 white soldiers, which is a very, very strong Japanese candlestick pattern. And the one thing that I have talked about the weeklies is that although you cannot trade off of them, they are excellent indicators in terms of the patterns that we see to get a sense or a feel for where the market's going to go. And I'll show you what I mean. When we look at some of the tops and the bottoms in these markets, we have this variation of a 3-river evening star here, and it's almost what we call a northern cross. Northern cross is when you have a doji that's in between, sandwiched in between this red and black candle, and it gaps above it. This is called a northern cross. If the entire body itself was above these bodies here, it would be called an abandoned baby. But as you can see, once we did get that, that was the signal that we had hit a tentative top in the market. This shooting star right in here. This is what's called a dark cloud cover, or maybe even an incomplete. Classic dark cloud cover needs to open above and then close about the midpoint or below. I have found in my research, when we looked at patterns and analyzed thousands upon thousands of charts, that a incomplete, meaning if it opens above and closes even above the midpoint, but is followed with that confirming candle, which is this black candle right here, you got a very, very valid signal. Excuse me, right in here, the shooting star right in here. You have a very, very good indication of a bottom formation right here. You've got, first of all, you have this hammer, and then that hammer is engulfed, and the engulfed is confirmed. So on a weekly chart, beautiful bottom indicator, beautiful top indicators right in here, right in here. And so what I'm simply trying to point out is as this market moved up, we got these very, very strong indications that we were at a top, that we were at a top, that we were at a top. Now, let's take a look at where we're at now. The only indication that I'm getting in terms of a straight candlestick pattern is these 3 white soldiers, meaning long-bodied red candles, which have higher highs, higher lows, higher opens, higher closes. In a true, the best formation is that the bodies are contained within each other. You don't get these gaps, but we don't have any true gaps because the low here and the low here. It is simply fascinating in that as we look at the weekly chart, there is still absolutely no indication that this trend is slowing down in any way, shape, or form. Traders, this is a 60-minute chart, cash market chart of gold. And again, I tend to look at these, as you know, to look for what I call the bands, which are just defined trading ranges. As the market builds a base, it will tend to trade in a narrowly defined area. and then at some point break out to the upside or downside. Of course, it has been predominantly to the upside. Once it does reach a new target or a new level, it will then go ahead and create that base. In other words, it will trade within that range for a while and of course look to break out one way or the other. Now in this case right in here, it broke up, created a new high. This is at 1210 and then came down and then slowly meandered back up, and then once again we saw this base being formed. You get a lot of activity or a lot of time in which it trades in that defined range and then breaks out. Now, here's what I'm finding interesting also. Here's this breakout to the first of our record tops at around 1365. As you can see, it didn't stay there for more than maybe 4 or 5 hours. And when it came down, it did come down hard, but unlike other times that we've seen the markets go to new record highs, such as when in December 2009, when it hit that 112.21, it came down ferociously. I believe it retraced 68% of the entire wave move up and did that very, very quickly. Here you do see a huge round of profit taking. The market does in fact come down, but here's what's interesting. It then forms what we call a tower bottom. A tower bottom in candlesticks is when you get these sets of lows that are equal, and this of course is your support level. So we had this base form, we had this tower bottom, and then again we had this breakout to the upside, and this is that move that took us to 1355. Of course, it ran into a little bit of resistance. It formed somewhat of a base, and as we're looking at right, once it formed that base, of course, it moved back down. Here you see a piercing line. The market moves back up. 1355 again, you see some pretty solid resistance right in that area. Now, the interesting thing is, though, as the market itself began to move up, and this is coming into our most recent move, we've got this again, these kind of tower tops, tower bottoms. So they're defining our support, they're defining our resistance. When we saw this move here, as you can see, it took that out very, very quickly. And this is that 1355. Continued to accelerate, and then you see this huge vertical plunge up to take it where it's currently trading at 1371. Traders, we're back to looking at our daily spot gold chart. I've put up our MACD, our moving average convergence divergence. What I find interesting about looking at that, of course, in terms of technical indicators, when you're at these new record highs, any of the real oscillator-based indicators that are comparing current to highest high are absolutely going to tell you all the time in a market like this that, of course, we're overbought. They really do not provide us with any kind of information. So I like to look at volume, but I do like to look at how the moving averages move, whether they're splitting apart, whether they're crossing, whether they're coming together, because that does provide us with information. If we take a look at some of the areas, for example, this is that first top, 1221 back in December, and we take a look at what happened. You can see that we had a nice cross here. If we take a look at the bottom, this is the beginning of that 1A wave. This is that bottom of the market after the correction. And of course, we follow that down. You'll see that we do get somewhat of an indication. And of course, this bottom of this last correction, this is our C right here. So our full count, in other words, our full wave count is 1, 2, 3, 4, 5. Correction A, B, and C. If we follow this down, again, we get a nice indication. But as you can see, the cross tends to come after the market has moved. It's moving averages, so they are going to lag. And as you can see, the cross comes after. And it's almost as though we need to use it for confirmation. Now, when we look at our moving average right now, they've tried to come a little bit closer. But as a rule of thumb, when we look at the distance here compared to where they first crossed, as you can see, they are parallel to widening. That gives me an indication that this current market cycle, meaning this move up, is not over. But as I said, 1400 is the first area that I believe we potentially might find some sort of resistance. Traders were in uncharted territory, so once we surpass that 1365, I have really no resistance points except to look at what we call psychological resistance points. Of course, 1400, the round numbers are huge. When it hit 1200, 1300, although 1300 it just kind of went through, and as you can see, it just kind of ran and continues to run up. My sentiment right now, though, is that the market, in terms of this wave, if we're going to follow classic Elliott wave, and again, traders, this is uncharted territory. We are in a Super Bowl cycle unlike we've ever been in. But if that does happen, we could, I underline, find some sort of resistance right here around 1400, and there look for some sort of a very, very shallow retracement. These two, of course, as you know, I've plotted a 23% retracement here and a 38% retracement, the 23 and the 38. And then, of course, what I've simply done is said that if wave 1 and wave 5 are the same and projected them, that's how I got us to this target of around 1465. However, one thing that we do want to take note of is that we are in a super bull cycle, and being in this kind of cycle, we could see an extended wave 3, or we could see it simply go to 1.61. 1.61 typically is a very, very strong wave. If you compare that to the other two impulse waves, meaning one which we've already had and the move itself, again, a $100 move, $161 move. If we go to, as I said, 1400 and then another $100 move, that's still a very, very strong set of waves. If you consider how shallow this retracement is, that's why I am anticipating this retracement to be also very, very shallow. This market can turn on a dime, but I can tell you this, it has followed Elliott wave quite eloquently. Elliott wave has allowed us to have some pretty good solid projections all throughout this entire bull cycle that we just finished. That's this 8-wave cycle, 1 through C. And of course, as you know, I've labeled this a super bull cycle right in here. And because of that, we might have to change some of the guidelines or the rules that we're working with. We're just going to have to see. Traders, record high, fascinating day. Of course, maintain the long position. We have moved our stops up. I am looking to add on any kind of a dip, and here's what I'm thinking as a closing note. If, in fact, it goes to 1400 and we get some sort of a candlestick pattern with confirmation that tells us that we might see some sort of a retracement, we might want to either A, pull profits here and then reposition, or go long when we hit the bottom of that correction, or we might ride the dip out itself, leave the positions on, and then scale and add more right in this area. That's something that we're going to look at over the next few days. Of course, first we have to get to 1400. But we're $20 closer to it today than we were yesterday. Maintain your long positions. Look at the stop placement that I'm putting up on the text email. And traders, I wish you great trading as always. We'll talk to you tomorrow. This has been Gary Wagner. Bye-bye.